It's great to have everyone here today. 3 years ago, when you put AI in a pitch deck, investors got excited. Today, you put AI in a pitch deck, which you better, everyone says, so what? Clearly, this is a huge change in the venture market over the last several years. And as we know, we are living through now like one of the most significant eras of technological change we'll likely see in our lifetimes. Because we see how AI is lowering barriers to building product, to launching companies, to reaching customers, significantly changing the landscape. At the same time, the level of noise is just off the chart. Because as any VC will tell you, VCs are seeing dozens of companies a day saying they're AI enabled, AI powered, AI first, AI whatever. The challenge, as all of you know as founders, is how do you stand out? How do you not only get their attention, but be worthy of their attention when you get it? Because as a practical matter, what we know is that with the cost of AI, with the cost of building a company coming down, everyone can build faster, they can build cheaper. And so the companies that are getting funded are the ones that are showing some sort of differentiating factor, whether it is a compelling market opportunity or customer traction or a founding team that has demonstrated their ability to see an opportunity, to pivot, to build a compelling company quickly, faster, and better than their competition. Whatever it is, companies are finding, they need to find that factor that'll make them stand out. Maybe they have a significant differentiating factor that's sustainable, which is increasingly difficult in this era. So that's what we're going to be talking about today. What is it that VCs are looking for in this market that gets them excited, that makes them interested in picking out this company out of these 20 other companies as the investment opportunity? What are the general opportunities that VCs are looking at, broadly speaking, where they think there is still traction, there's still money to be made? And finally, and really importantly, for you as founders, what is it that you can do to stand out in this marketplace, to stand above the 20 other companies that are maybe doing things similar to you, and to get the attention of the VCs? So that's our task today. Good afternoon. I'm Paul Ellis. I'm the managing partner of Ellis Law Group. We are a firm that does a lot of work with venture companies, venture-backed companies here in town. I'm really pleased to welcome you to our event today, Standing Out in the Age of AI, standing out and getting funded in the age of AI. We have a really great panel today, experts in this field who, as a group, see hundreds of companies a year, whether they are seeing them as investment opportunities, analyzing them, advising them, but they have the real finger on the pulse of the marketplace. So we have Steve Socolof, who is a managing partner of Tech Council Ventures. We have Alan Wink, advisor capital markets to EisnerAmper. And we have Spencer Chandlee, who is general partner of Cardinal Ventures, and a venture partner with DataPower. You all will have to excuse me because we had a last-minute cancellation. 24 hours ago, Spencer and I had not met each other, but Spencer jumped in at the last minute. Someone recommended him to me. I saw his profile. I said, this is the guy. So it was all right. It's 24 minutes. Yeah. Anyway, no, we're delighted to have Alan, Steve, Spencer to go over this topic. Before we jump in, we're going to do quick introductions, go down the line. Again, my name is Paul Ellis, managing partner, Ellis Law Group. We represent venture-backed companies and venture funds. We work with companies that are looking for efficient, cost-effective solutions to their legal issues so they can focus on building their companies. In addition to doing venture finance, We work on the life cycle of issues facing early stage companies, whether it is formation, employment agreements, IP protection, equity plans, general operations, M&A exits, those life cycle of issues. All of our attorneys come out of top law schools, major New York firms. So we have the ability to give large firm expertise with the more personalized attention and reasonable cost structure of a boutique. We get a lot of clients that come to us that were with the big firms that find that we can offer them a better rate structure, better retention, same expertise as the big firms. Happy to speak to anyone today or later. Alan?
Sure. Good afternoon, everybody. Great to be here. Paul, thanks for inviting me. Alan Wink. I was formerly the head of capital markets for EisnerAmper, a global accounting and advisory firm. I retired in January after 27 years with the same firm. I'm actually still involved in the tech ecosystem in New York and New Jersey. I formed an LLC called JLD Capital to advise pre-seed to Series A companies. And I'm also an angel investor in a group in New Jersey called Jumpstart New Jersey.
I'm Steve Socolof with Tech Council Ventures, as Paul said. I've been in venture for about 25 years. I started as a corporate VC and then transitioned to I had a platform that for about 15 years, we had a US and Europe strategy. And about 10 years ago, I saw the opportunity here locally and in the region, decided I didn't have to travel as much as I was, and I could be closer to the company, jumped on board with Tech Council Ventures. I was in New York when I started my venture career, but I'm a New Jersey resident now. And Tech Council Ventures is based in New Jersey, but we have a regional mandate. So we're investing across New York, New Jersey, Pennsylvania, North and South a little bit, early stage generalist fund, and happy to be here. Excited about Tech Week.
Excited about Tech Week. Hey guys, I'm Spencer, run a firm now called Cardinal Ventures. I started my career very lucky to work under some incredible founders early on their teams before they then went on to become unicorns, and then decided to start my own companies. Very misled by those two founders. It is not easy, and I'm sure we'll get into that. But after my last company, I wanted to switch to the dark side and started Cardinal, joined DataPower to also investing in secondaries, which I know is a topic later. So I'm very excited about that. And then I run a community of GPs and LPs around the world called Peer.
Great. Again, thank you all. Really pleased to have you. Also pleased to have you, Spencer, as a recent entrepreneur. So you can call BS on the rest of us when we say, that's not.
I will. I'm ready.
Okay. Feel free. We're going to we have several themes we want to focus on today. We are going to start with talking about the market generally, what the venture market looks like. I'm going to ask each of you just to take a couple of minutes and give us your sense about what the venture market looks like for AI and AI forward companies and everybody else in a sense, because that is something that we are seeing in the market right now. How AI companies are getting funded more easily and more readily and more expansively than everybody else. But what you're seeing in the market and what's coming up in the next few months or next year. Alan, you want to start?
I think it goes without saying, definitely a bifurcated market. There's AI and everything.
I was
not that word.
Okay, nice bifurcated too. That was in my speech.
The right word.
Next time we'll start with you.
Thank you.
It's AI and non-AI. I think it's a really interesting time right now because I think you're beginning to see the IPO market coming back to life, and both for AI and non-AI companies. 3 very significant IPOs over the next 3 to 6 months at values that are crazy. I read something in the Wall Street Journal the other day. They say that the total addressable market for SpaceX is about $28 trillion. I don't even know what $28 trillion looks like.
You listen to the roadshow?
So I think it's an interesting time to be an entrepreneur, both for AI and non-AI companies. Hey, look, and these two guys could probably answer this better than I can. I think VCs are still looking for the same things. They're looking for great teams that have done it before, large addressable markets, and a great product.
Yeah, I'll say, first of all, I'll counter a couple things Paul opened with just to start the ball rolling here. But I don't think VCs say so what to AI anymore. 2/3 of VC dollars are going into AI right now. There's a very strong interest in those opportunities and the markets they represent. And Paul talked about the leverage of AI in building, launching, moving your company forward. But really, that's all great. And there's a lot of companies are talking about AI first, AI native, and all of that. But the opportunity that AI represents in terms of enterprise transformation, consumer transformation, et cetera, is huge. And that's what everybody's betting on. And people are putting a lot of money into those theses across all kinds of companies. There are almost 5,000 vertical AI deals got funded last year, and almost 2,000 horizontal platform deals got funded last year, not even counting the money going into the foundation models. So it is a very high interest and viewed as a very huge market opportunity.
Can I just say?
I see one or go. I want to counter something he said too, but no. When you said bifurcated, I thought you were going to steal this thunder, but I don't think it's an AI versus not AI bifurcation. There's a have and have not bifurcation. So there are deals are getting bigger, higher valued, more money, and a lot of deals are struggling to raise money. So there's a bifurcation in who's getting the money. I've seen $20, $40, $50 million seed deals with the right teams, with the right pedigrees going after big opportunities, and a lot of other people struggling to raise money. And the same thing is happening on the exit front. So Q1 blew the numbers out in terms of invested dollars. More money went into venture in Q1 than in all of the prior couple of years. But 70% of that money, I think, or 75% of that money was like 5 deals. So there's a lot of other people raising a little money. And the exits are the same story. Huge exits in Q1, and VCs are eternal optimists. It comes with the territory. And so we're always looking for signs that things are getting better, despite all the market and geopolitical and everything uncertainty. But we get excited about SpaceX because we think it's going to open the doors for a lot of other companies to follow. But again, 80% of the exit dollars is going into a few companies. I think 90% of the exits announced in Q1 had undisclosed deal values. They were not great exits. So the bifurcation is a have and have not bifurcation.
Yeah, I'm excited to chat about the kind of not I hate using the word zombie like unicorns, but because those companies are still growing, they're built great businesses, they're amazing founders, but I think we'll eventually get to that. There's another bifurcation because we all want to use the word. I know, let's go. But it's also on the GP LP front. I'm sure everyone sees every massive fund announcement, whether you're a founder or a GP, but all the capital is not just getting deployed into the same companies, but it's also the same funds. And it's kind of crushing emerging managers who are the ones that are a little more open to taking bets on founders that you wouldn't normally invest in. And that's where kind of the real alpha and on the edge investments that you can make. And we're seeing a ton of conversations around trying to get LPs, hopefully post all these IPOs, into some managers that want to take real risks. I think on the builder side of things, it used to be compared like, okay, could your company be built by 3 PhDs from MIT? And I think it's probably still the same measurement, but it's also, could a 15-year-old with unlimited time and Claude build your company? There's just so many tools out there that you could probably run or build a business that used to cost hundreds of thousands, not millions of dollars, for a couple $100 and a few subscriptions. And if someone has higher agency than you as a founder, you're going to lose that battle 10 out of 10 times. And so I'm super excited about when the super technical founders team up with those super commercial founders, and they have extreme industry knowledge. They have embedded relationships that they've built over a career, but they're able to build with the most recent tools that might have come out a week ago, a day ago, an hour ago on Twitter, who knows?
So let's move on. As promised, we're going to start down with you, Spencer.
Now I don't want to.
You'll get your choice of the choice words. So as a VC, what is it that you're looking for in this market where things are moving quickly, where there's many companies going after the same strategy? What differentiates a company that you will fund against one that you decide isn't going to go the distance?
I'm early stage, so I'm investing mainly in seed, Series A within reason. And we're still underwriting against the founder and the teams. And so when I meet a founder, when I meet the team, I'm underwriting, okay, will this person go the absolute distance as an individual? Because the company they're building now is not the company they'll be building in a year, 5 years, 10 years from now. And so when I meet them, I'm asking them, okay, what's your unique distribution mode? Are you taking a unique approach to get to your customers? Are you waiting for people to come to you and just building your product infinitely? Or are you actively texting, calling your customers every single day? I think Corgi is an extreme example of what he was talking about, but he's sleeping in the office. He's a mattress in his office. Are you that founder, or are you a founder that, goes in, not to shame WeWork because it's a great company and a great space to work, but are you just going in 5 times a week? You go in 9 a.m. to 5 p.m. That's great, but you're not going to beat the founder who is like ultimately driven and is going to outwork you every single day. And even if they're not as technically savvy, all of these software updates and all of the platforms that have come to market now just completely remove any kind of technical moat unless you're building in hardware or infrastructure where there is a real either manufacturing or supply chain moat that you find.
Yeah, I'm bold and I'm not a marketing guy, so I always have these ideas, and then I hear all of a sudden the industry's got great words for it. We used to talk about product market fit, and that was around. And then I always used to say, I really like to see founders who live the problem, who lived in the industries they're trying to change or bring a solution to. And now I hear everybody's got this term, founder market fit. So I think that goes along with investing in the right founders who really understand the problem, who really think they understand the solution they're trying to bring to it and what it's going to take to sell it in. So that's really important. And then technical leadership. You got to be, I think a lot of these opportunities, I used to call them land grab opportunities, but there is questionable moats to a lot of what's going on. And you're going to win only by moving really fast and grabbing land, grabbing market share, grabbing customers as fast as you can. So we tend to be, there's a lot of teams out there raising a lot of money with basically teams with great pedigrees. But I'd say for us, we tend to be more seed early A. So we do look for some early market traction that shows that the founders are building something that's really valuable and they're able to go and sell it, particularly for us to enterprise clients, which is not always an easy sell.
I thought you were going to go in a different direction. I hear the word coachable when you talked about people. You should have used that word. And I think that's the other thing. I think VCs want to work with founding teams that they believe are coachable, that can take criticism and pivot and move on to the next direction. But I also think, as Steve mentioned, I think the ability to get to customers quickly. I think investors want to see a clear path to revenue and even now a clear path to profitability and growth. It's not about just the top line. It's certainly about the bottom line now also. So I think it's team, proven profitability, proven cash flow positive are the things that you want to look for.
I think the coachability thing, I like the word obsession, I think there's a great movie called Obsession now, so maybe it'll come back. But are you truly obsessed with your problem and not obsessed with your product that you've built? Because I think it's very easy to look at your baby that you've spent days or months or maybe even years building and be so torn when either someone doesn't buy it on the first call or you get some meh feedback from a customer and you're like, no, the next person will love it. The next person will love it. You'll end up doing that for a year. And I think you have to be willing to be flexible, not just with your VCs, but also with your customers. Because like we can talk about AI all day, but what it comes back to and what the best businesses will be built on, are you solving a real problem for people? And so if you're not trying to find a problem and build a solution around it, and instead you're trying to frame the thing that you love and find who's willing to buy it, I think you're in for an uphill battle.
And I go both sides on the coachability issue because it's a relationship, right? From the time you invest till you get out, you're in there. It's nice if you're out in 5 years, but it's 8 to 10 years most of the time. And so there's a relationship and you've got to be able to work together, and you've each got your own priorities and experience and perspectives, and you have to be able to work together to solve problems and create success. But I've got first-time CEOs who are using up a ton of time looking for coaching, and I got CEOs that don't really need a lot of my time, and I really appreciate that as well.
Point counter. Okay.
All power to those who can figure it out on their own.
I will say, my firm, we represent startup companies and we represent venture funds. And those emerging managers that are like out there struggling right now. But when I speak with my VC clients about how they make the choice, how they evaluate a founder, one thing, and it goes to this point about how hard do they work? Like, how focused are they? Are they sleeping in the office, whatever it is? And one thing they say is a good proxy for them when they speak to a founder is if they give a question to the founder, or what do you think about this? Or get back to me on that. They're interested in how quickly the founder gets back. Like, how fast do they move? How focused are they? Because when you're a VC, you're just trying to build a relationship with the founder, find out like who are they and how do they roll. And you need a bit of a proxy for some of these things. And one proxy that I've heard is pose a question, pose a problem. How would you solve this? And see how quickly the founder gets back and how thoroughly and how focused they are as sort of an indication of how much do they care? How quickly do they move? How much do they want it? How hungry are they? So I don't know if that means something.
But Paul, I'd add one thing. Not only is it,
Yes, it's giving me the counter.
not only is it the quickness of the response, but also it's the communication of both good news and bad news to the investor. Everybody can communicate good news. It's the bad news that everybody struggles with. And you have to be honest with yourself. And if things aren't working out, you have to talk to your investors, talk to your board. It's important.
The best investors want you to be as honest as possible, because we should we're not providing a ton of value for most of the company. Hopefully we can help with some customer intros, maybe some key hires, but in the end, like, the founder's the one building the thing. And we can really be helpful when we know all of the information. So if you're sending qualitative updates every month of, oh, we talked to a bunch of customers, or, oh, we're in conversations with some enterprise clients, like, we scan that and we're like, okay, great. They don't need our help apparently. And like, subconsciously, I think we register, okay, there's no quantitative updates. They're not flagging any issues, which there should always be issues, unfortunately. But if you tell your investors what's going on and what is going wrong with the company, ideally the best ones, or the ones you want on your cap table, will be there for you and will give you a call immediately and say, okay, how can we work through this? How can we get that customer to reverse their decision? How can we try to fight for this employee you're really trying to get? So be completely honest, whether it's good or bad, and more so on the bad stuff, please.
Yeah, absolutely. The VCs they'll see the bad stuff. They'll figure it out for themselves. So better that they hear it from you, because that builds honesty, trust, and they'll recognize that you're going to deal with them straight ahead. So I'd say that.
Yeah, like I said, it's a relationship, and it definitely works best when the board and the investors and management team trust each other and are open with each other and can talk about what's going on. So seen many examples of the product really isn't working as well as it was purported to work. Like, we want to understand that. We want to understand when they try to deploy at a customer and it doesn't deploy, like, what's going on, or why did we lose that customer, or why is it rolling out slowly? We want to understand that. Or a lot of people get fixated on, everyone thinks they're going to land customers faster than they usually do. What's going on? How do we really sell them? Why is it taking long? Do we have the story right, etc.? There's so many challenges, and if you can be open about it and, again, trust each other to work together on these problems, it's way better.
I think there was a good interview with Mark Andreessen just on the funnel piece. I think is important for founders that are fundraising right now. I think his quote was, 10,000 people have my phone number. If you can't convince one of them or find one of them that's dumb enough to give it to you or introduce me to you, then I'm not going to take a meeting with you. So use that beginning portion, as you mentioned at the beginning, to prove and show how you function, how you work as a founder, and how hard you're going to work to build your business. Because if you're not working hard in the fundraising process, if you have 10 term sheets, do whatever you want. If investors are coming to you and they're asking to invest and you're the hottest thing in the market, you don't need to do this. But if you don't have any customers yet, or you're in beta, like, you need to show the investors that you do get in contact with, that you know how to find them, you know how to get in contact with them, get on a call with them. Because if you can't do that, means you won't be able to fundraise for your Series A, which is a lot harder than raising for your seed or pre-seed. You definitely won't be able to get the best hires that you need to build your company. It's also showing how you may engage with customers. It might be subconscious, but it's also a testament to how you're going to behave as a CEO and a leader and how other people might see you. So use it as a good proxy, I think, is a great way to say it.
I want to bounce off of one thing Steve said, this idea of bad news. In the process of pitching the investor, that's if there is something you have, a problem you haven't solved yet, something that you haven't figured out, lead with, I would say lead, but make sure you're the one that identifies that. This is something we haven't quite figured out yet that we're working on. Again, that goes to the sense of honesty and transparency that the investor is going to be looking for. We can do some Q&A as we go.
Hi, my name is Dee Dee. I heard you all talk a lot about teams and great founding teams, which is totally great, but I want to know what's your thesis on solo founders?
Are you ever going to have a team, or are you just going to do the whole thing for yourself?
One person unicorn. Let's do it. Okay.
No founding team, just a solo founder.
There's some apocryphal stories out there now about solo founders who create $1 billion of revenue on their own. But yeah, I think you're just, in general, you're probably early stage. It might be too early for me, but maybe for Spencer, who's doing pre-seeds, might love your idea, might love you, and might want to find a way to back you. So you just have to find the right VC that's looking for the right stage there.
Even in the angel space, even angel investors today want to see teams that are a little bit more developed than one person. Another point on the team is I've worked with a very well-known VC here in New York that whenever he comes across a second-time entrepreneur who's had a successful exit, if a majority of his team from the first company don't come over to the second company, he won't invest. I don't know if you guys do the same thing.
And some of the bigger funds will actually, if you had a good experience and they like you, they'll bring you in for a little while as an entrepreneur in residence and help you get something launched. Now there's a growing kind of little world of venture studios out there that want to help create startups. So again, there's a place for almost everybody in this ecosystem.
I think it's possible. I think you really have to want to go about it alone. It is very lonely and it's emotionally draining as well as physically draining. And you can't be like that way in front of a team that you have. To have a counterpart that you can be 100% honest. And if someone's not at 100% on a given day, you can lean on them. I think there's also, it's probably impossible to have every trait needed to build a successful company as one person, unless you've done it several times before or can fill in the gaps very easily with the founding team. But yeah, I think I probably lean more towards, I think I mentioned like technical counterpart, deep industry expertise, just because I'm mainly investing in legacy industries. And so having somebody that can sell into customers and then the other one to build a product is ideal, at least for my fund.
Any other questions right now?
What are your thoughts on SaaS companies? Are they dead?
I think AI companies are largely SaaS companies, but I do know, I quote we have a close advisor who's a CIO of a $1 billion company, and he told me he's going down their list of vendors and deciding which ones they're going to build themselves. I was with one of our corporate strategic investors this morning, and we had this same conversation. If you're not tightly embedded in core work process and you're not tied to enterprise data, you're going to have trouble being sticky over time because the tools are getting better and better to build your own.
It depends on the industry. I think if you're at like the forefront of just, trying to be a general SaaS company for everyone, CRM, I think it'll be tough. But if you're building in an industry, and I see a lot of these where is very much vertically integrated, and the goal is to be as sticky as possible and hold their customers not like hostage, but be as sticky as possible. A lot of those customers don't know how to use AI and they're not training their employees. They don't want to use AI. Their data is extremely important to them. And the timeline for adoption is a lot longer than like these public enterprise clients that normal SaaS companies sell to. So it's just back to the thing of, are you solving a problem? What problem are you solving and who are you solving it for? And if it ends up being a SaaS company is the perfect answer to that, amazing, it'll work. But if it's not, and you're just building a platform that's generalized, I think it'll be tougher.
Can I bring up another topic, which is to me really important as an entrepreneur, is understanding economics. And too few entrepreneurs really understand their value proposition to their customers. and can really figure that out and articulate it, not just for customers for future sales, but even as they communicate with investors or other partners in their business, really focusing on the economics that you're creating for your customers and also the economics of your own business. Too many founders don't understand the way cash flow cycles work, revenue cycles work, the cost of what they're building, the cost of cloud resources or other resources above the gross margin line, expenses below the gross margin line. So really understanding economics well. And with AI and automated workflows and all this, it's really upending for enterprises the whole sort of, are we human workers versus AI workers, and how all of this mix is going to play out over time. So I think those are going to be more and more challenging equations, but really critical to a successful entrepreneur.
Steve, do you find that most entrepreneurs don't understand how much capital they need to raise to get to the next level?
I'll say that, first of all, if you're going to take venture money, you have to have a real growth plan, because we don't want a slow growth deal. And if you're going to have a real growth plan, you have to understand how you're going to fuel that. And I think people generally do, the earlier people often underestimate what it's going to take to build a real scaled company.
This is also some inside baseball on like how I talk to founders for the first time. I usually try to convince them not to take my money. I usually try to dissuade them from raising venture capital at all. And if they can give a good enough reason why they really need VC dollars, because it is like the most expensive form of capital you can get, then they obviously have thought about it for a long while and they actually need it as a business. But yeah, if you don't know why you're raising because you saw somebody say they raised $10 million and you're like, oh, I guess I need to raise $10 million for my business, then we're in a different place.
Could you elaborate why is it very expensive to at least VC?
You're giving away your company.
Can you repeat the question?
I think the company was, why is it the most expensive?
Why is it so expensive? Why is your money so expensive?
It's our money. What do you mean? Why is my money? Your money too, man. You're giving away your company. And if your plan is to build a billion and now $28 trillion company, would you want to give away 20% of your business, 15% of your business, even 10%? If you could just grow that over time, I think a lot of founders, and I've been in this situation before, I've built bootstrap businesses, I've built 2 VC-backed businesses, and I can tell you, you can probably achieve a better outcome for yourself, like both sanity-wise and financially, a better outcome by not raising VC dollars. I think you have to be a little bit crazy to want to build a VC-backed business. Like, you are setting yourself on a fixed trajectory straight up in the best outcome. And in the worst outcome, you are tied to this thing forever until you somehow find a way out for you and your employees and your investors. So if you can find a way to not do that, means you can take a day off, you can spend your time with your family. That is a much more sustainable route to go to. And so if a founder can do that and be happy, I would rather them do that than force themselves into a position where they raise a bit of capital and then they have to do this forever.
But the other part about that is the cheapest form of capital is debt. And as a pre-seed company, you can't raise any debt.
Yeah, don't do that.
Yeah, I'll jump in on this one because when I speak to my clients that are thinking about raising venture money, we often have this conversation about, and I drive home for them what their take, especially first-time founders doing this for the first time, first round of VC money, what they're getting themselves into. And we spend some time talking about the alternatives, about bootstrapping, about vendor financing, there are a lot of other alternatives out there if you think creatively and if you're prepared to look at other opportunities, other ways of financing. The thing is, the industry has this bias towards VC. It's like, you're a startup, you start a corporation, you raise VC money, you go. It doesn't have to be that way, but it's up to you all to think about what the alternatives are and make sure you know what you're getting yourself into and you know what choices you have and make good choices.
And I just say the real answer to your question is, despite all the economic ridiculousness, the stock market's been fantastic for years. And we're asking our investors to give us their money on 10-year lockups. And we're going to invest it in deals that half of them are going to go dead or down or whatever.
Oh, yeah.
So we have to generate on the deals that work a lot of money to pay off our losses and pay investors a premium over public markets for the lockup.
Hey, thanks for the panel perspective. What's your thoughts around IP and patents these days and the value of that?
Is there a specific industry?
I used to say, I talked about land grab earlier, so I always used to I still do, divide the world of venture into kind of deep tech, IP, and land grab. So most of this AI stuff is land grab, like all these 5,000 vertical AI companies. That's about going out, building something that works really well, building customers, building revenue really fast. And in my mind, staying ahead of a train, as the foundation models and the tools that they're spitting off are coming after you. On the sort of deep tech IP world, those are deals where you're often competing, whether it's healthcare or energy or materials. These are worlds where a lot of the companies you're competing with have tens of thousands of engineers who think they can engineer anything you're doing. And you can be innovative, you can demonstrate something maybe they didn't get to first, but if they put their mind to it, they'll come after it with all their resources. And so in those cases, IP is really important.
So I'd like to go to another question. Yeah, in light of this, for founders who are raising venture money, how do you advise them? What should they be doing to stand out, to demonstrate that their company is a compelling investment opportunity for you guys? Steve, maybe we start with you.
Yeah, get to me in a good way. Obviously, warm referrals, or if I already knew you, those are all positives. Build a relationship, gain some trust, share your view of what you're trying to do so that I understand the founder market fit. So I understand you've got the technical capability to build something unique, and show me grit that you're going to go after it with. And that's what's going to win me over. And we're not in New York. I think you live in New York more. So I hear there are deals that happen in weeks and people get excited about founders and concepts. Out in New Jersey, we take a few months to get to know our founders. So we want to build a little relationship before we invest our money.
I could write a check pretty quickly. We talked a lot about showing like grit. I think another thing to mention is a level of clarity about how to build your business. I think understanding, and like, I want to learn something. If I'm on a call with a founder, I should not know more about the space than you. I should not be able to do a bit of research or bring industry expertise from 5 years ago, 10 years ago to the conversation, and it be more relevant to what you're building than what you're bringing to the table. You should just be the person that we're assessing. We talked about like the economics that we're looking for. We're looking for an exit that could be worth $1 billion, $10 billion plus dollars. And so are you going to be the person, the one of maybe 1 or 2 or 3 people in a given year to do that? I'm not looking to invest in the 100th best founder in a category. I'm sure those people are great. I'm sure the 100th best and the 99th are great people, but I don't want to give them money. I'd rather give the number 1 person. So if you can demonstrate on a call in the way that you're getting to me, getting to Steve, I think, I was talking to a founder the other day who said that he spent all of his Friday nights from 5 p.m. to midnight going through LinkedIn. He pays LinkedIn requests, and then he sends a custom video where he has drawn their name on a whiteboard, and he writes a custom message and sends a video in LinkedIn, and apparently has a 90% conversion rate. And I might have just spilled his sauce here. Maybe there's going to be a lot of videos on LinkedIn after this, but that is genius, or that is at least creative. And so are you trying crazy things to either get in front of customers or other investors and just demonstrating momentum? If we're talking about you doing something and you commit to me that you have 5 customer calls scheduled for the next day or within the next 3 days, and we check in the next week, none of that happened. Subconsciously, I'm like, okay, he didn't really stick to his word. That's fine. But it builds over time. And I think just doing what you say you're going to do, committing to it, and then just building momentum without our money shows that, okay, if we gave you money, this thing would just take off.
Yeah, I think I'd even be stronger than that. And related to this question, and one of the prior topics is over the course of getting to know each other, building a relationship, the more we see you making progress on what you're doing, the more traction you're getting, the more evidence that is of the potential for future success. And if you're going to go down the path of raising venture money and you aren't a founder that, for whatever pedigree, can quickly attract a lot of money, the more clarity you have over how much money you need and what you can deliver with it by means of proving the opportunity out in terms of the customer interest in what you're offering, the value of what you're offering, et cetera, the better. And that's what will drive us to the close on the sale.
I think investors are also emotional creatures. We try to distance ourselves from FOMO and making like instinctive decisions and getting to know people over time. But if it feels like there's zero momentum on the round and you've been raising for 6 months, it is not a red flag, but it's just something that we consider. And so the power of doing monthly updates, the power of momentum is it slowly gets us feeling like there is an end point. And if we miss it, then this thing is going to be 2, 3 plus times more expensive next year, and they won't need our money anymore. So you have to convince every investor that you want on your cap table that this thing is going whether they're on board or not. And if you can make them think that, which hopefully it should just be doing that anyways, but if you can make them think that, then yeah, they'll be a bit more likely to write the check.
We also like it when we see that you can sell what you're doing.
Exactly.
And we're not the only one to put the money in.
Be great if we're not the only people on the cap table and then the company just disappears off planet Earth.
Spencer, I want to jump off of something you said. Maybe you guys could each identify an area that you think that you're excited about to invest in, and maybe an area that you think is oversaturated and its best days are behind it.
I think that question is a little bit fund specific. So for example, we closed our raise on our new fund back at the end of last year. We've made a dozen investments in this fund. We've made 3 kind of application layer AI for the enterprise investments. So I feel a little saturated in terms of this fund in that space. And I want to see how these play out. I'm more interested, now there's a lot happening around AI governance, AI infrastructure for the enterprise, things like that. And I'm interested in that surround and what's going on there. So that's just one example of where my head is.
I mentioned my thesis is more so around legacy industries and bringing prior operator and extreme technical co-founder in to solve real problems. And I think I'll stand by that. I think there's cycles of where innovation is really desired from certain industries, certain buyer profiles, and their willingness to try something new. I think if you can pitch a full vertical capture, and I think a lot of what companies are trying to pitch is, okay, we can replace this employee. And I think a lot of companies are realizing that they got rid of a lot of employees and the AI is not doing what it said it was going to do, or it's compromising or costing them more to run that than it did just having a normal workforce. And so I'm trying to stay away from the, okay, we're just going to get rid of a single employee's function. I think supporting the existing teams and making them that much more powerful and potentially replacing their full stack of tools that they had before, all these legacy software businesses. I do think SaaS is in a bit of trouble, to the earlier question. I think if you can build a full vertical application because the speed to development is so fast, I love that. And so if you're bringing the expertise and you can sell into customers and replace 10 different platforms and services that they were using, that's amazing. And you're going to become immediately sticky if you can transfer all of their information, all their customers, without putting that at risk and compromising their information. That to me is extremely attractive.
The other thing I would say is there are VCs out there who are very strongly thematic and they have deep experience in certain focused areas and they're trying to drive for opportunities in those areas. And maybe they're looking for very coachable VCs because they think they know better what to do. But we're a generalist fund. So we're really looking for the entrepreneurs to educate us about an opportunity. So just to make another example, we've made a couple investments in the robotics space. and this is physical AI, machinery. And through that, I've seen a number of challenges for robotics. So we've been diving deeper into the world of AI for robotics, physical AI, world models, things like that, and trying to figure out what is the right bet to make in that space. So that's an example where, in part, we're entrepreneur-led down a path of opportunity.
The other point, I think you both made it, when you approach a VC, understand where they're investing today. Understand the check size that they write. Make sure it's compatible with what you're trying to raise. And probably the worst thing that you guys see is when an entrepreneur comes to you and it's a space you would never invest in, a check size you would never write, big or small. There's so much information out there about each VC today. Just understand who you're talking to. And as Steve said, a warm introduction is so much better.
I wanted to go to that question. How should they, not just you guys, but VCs in general? Warm introduction is great, doesn't always work. How should these founders go about the process of contacting VCs?
Tech Week's a great start. You look at that schedule, there's like 1,000 activities. You can pick anyone that's a fit for what you're doing and go there, and I'm sure you'll meet a handful of VCs. You're in a great place. New York is now the second largest venture ecosystem in the US. It's about 2/3 the size of the Bay Area, so it's incredible to me. 500 deals got funded here in Q1. So you're in a very rich environment, and there's a lot of investors in New York. So it's not hard to find your way to a few of them.
Spencer?
I think if I get a founder referred to me by either a founder I've already invested in or a co-investor I trust, and I think there's different levels to the warm intro, but generally if someone that I believe is a great judge of character and a founder profile, then I'm much more likely to take that call. I think cold inbound is very tough. There's so many tools that make that easy. If I can tell that you wrote a message in 10 seconds or sent out an email sequencing campaign to every VC in New York City, then I don't know how many of those are going to reply to you, unfortunately.
I'll say most states and municipalities now see venture as a driver of economic development. So there's tremendous support networks out there to help early stage founders. So you take New York City, there's New York Ventures. There's, I forget what New York City calls its venture capital fund. There's a bunch of accelerator incubators. The universities all have programs. And they all have that. It's not just about the money. They all have a mission of economic development and driving business growth and driving job growth. So there are plenty of people out there to help you find your way to investors.
And also there's a ton of angel groups around the country that are providing capital, lawyers, but these angel groups actually write checks. And if you're looking to raise $1 million or less, I would go to angel groups. And there's certainly numerous numbers in the tri-state area.
Angels, I would say I'm not going to give an exact percent of like how many are going to be more helpful than a VC to you, but angels likely have smaller portfolios, which means they probably have more free time, which means they have more time to spend with you. And ideally, you're getting angels that are strategic and know what they're talking about, at least in the space that you're investing in. But generally, they will be more forthcoming and will want to be more helpful. And the unfortunate fact is like VCs have a massive portfolio. If they've been around for a while, they have even larger. And they're going to prioritize naturally towards the companies they think are going to succeed, help them return their fund. And if they don't think you're one of those companies, they're going to spend a lot less time and their responses are going to take a lot longer. Whereas an angel, whether you're top of your class, whether you're struggling, like those are individuals who care, fell in love with the business, love you as individuals. And so if you can get a great collection of angels together or syndicates that are made up of angels, like.
So I'll do the counterpoint to that. I agree that can be the case, but in my client base, there's all sorts of angels. Generally VCs, in my view, there's less variability across the class of VCs than across the class of angels. For angels, you have like super sophisticated angels that are like as knowledgeable, as sophisticated, as useful to you as a VC. Then you have others, not like the proverbial doctors and dentists who like they've got money, they want to invest. They don't really know much about the space. And sometimes it can be more trouble than they're worth. They like when they'll be coming back, they'll asking you a lot of questions. It's not sophisticated questions. They're not adding value. So I agree with Spencer that angels can be immensely valuable to you, but choose wisely because angels are not all created equal. That's what I think we're going to have one wrap-up question, which is to you guys. If there's one thing that you'd like these founders to, when they wake up tomorrow morning, thinking back on this panel, like a key takeaway that they should have, Spencer, starting with,
I thought I was going to have time to think. Shoot. I think if you find out what problem you're solving and be very honest with yourself about how big the problem is, who you're solving it for, and find those people and figure out whether you're actually solving it. I think the worst is if you're just trying to fit what you've already been doing into a customer profile and get them to buy in. Make what you're building the thing that they need more than anything else.
Remember to give us a 10 on the follow-up survey.
Yes, it's that as well.
And no, just wake up and feel like, look, it's hard, but it's doable and you're in a great place. And there's a lot of resources that want to help you succeed. So feel encouraged.
Better times ahead. Perfect your pitch and be a great storyteller.
all right. All right. Listen, Spencer, Steve, Alan, thank you so much. Let's have a big round of applause.